Listen carefully, because what is unfolding in silver right now is not a routine pullback, and it is not something that resolves itself with time. I am not talking about a minor correction. I am talking about the early stage of a structural shift that most participants are not prepared to recognize. You need to understand what is happening beneath the surface, because what you see in price is only the visible expression of something much deeper. Markets do not move like this without reason. They reflect pressure, and that pressure builds over time through policy decisions, capital flows, and behavioral patterns that most people never fully examine. What you are witnessing right now is not randomness. It is the system beginning to show strain. Most investors are looking at silver and asking simple questions. Why is it dropping? What changed? They focus on headlines, on daily fluctuations, on explanations that feel immediate and comfortable. But that is not where the truth is. The truth sits inside the structure of the system itself. Because when a system begins to weaken, it does not announce itself clearly. It signals. It creates tension. It behaves in ways that seem confusing unless you understand the mechanism behind it. This is not speculation. History has proven this again and again. Every major dislocation begins the same way. It starts with a narrative that makes sense. In the case of silver, that narrative is rooted in inflation, currency debasement, and the steady erosion of purchasing power. These are real forces. They are not imaginary. That is exactly why capital flows into assets like silver in the first place. But the real issue is not the narrative. The issue is what happens after that narrative attracts participation. Because once enough participants enter the same trade, the system begins to change. Your early positioning becomes momentum. Momentum becomes crowding, and once crowding takes hold, leverage follows. This is where the structure shifts. You are no longer dealing with a simple market driven by supply and demand. You are dealing with a system amplified by exposure, where even small movements can create outsized consequences. Most people misunderstand this completely. They think risk is volatility. They think risk is how fast price moves. But risk is not defined by movement. Risk is defined by structure. It is defined by how positions are built, how they are financed, and how they behave when conditions begin to change. When leverage expands, the system becomes fragile. It may look strong on the surface. Prices may have moved higher. Confidence may have increased. But underneath, sensitivity builds. The system becomes vulnerable to disruption. And this never ends quietly. When fragility reaches a certain point, the system does not adjust slowly. It adjusts through release. That release is what most people interpret as a sudden move, but in reality, it is simply the result of pressure that has already been building for a long time. Now think about what that means for you as a silver holder right now. If positioning has become crowded, if leverage has expanded, and if participants are expecting continuation, then the system is already exposed. It does not require a major event to trigger change. It only requires a shift in conditions. And that shift is already beginning. You can see it in tightening financial conditions. You can see it in how capital is becoming more selective. You can see it in how quickly sentiment turns when price stops behaving as expected. These are not isolated signals. They are connected. They are part of a transition. The real question is not whether silver has long-term value. The real question is how the system holding that value is structured right now, because value does not protect you from forced behavior. Structure determines outcome. And when structure weakens, price follows. This is where most investors make a critical mistake. They assume that because the long-term story remains intact, the system will stabilize. They assume that what worked before will work again. But cycles evolve. Each cycle builds on the last with more leverage, more complexity, and less tolerance for error. That is why timing is not about predicting a specific moment. It is about recognizing when conditions shift from stable to unstable, when the balance changes, when the downside begins to outweigh the remaining upside. Most people are not trained to see this. They wait for confirmation. They wait for clarity. But by the time clarity appears, the move is already underway. Smart capital does not operate that way. It does not wait for obvious signals. It studies structure. It observes behavior beneath the surface. It identifies when a system is becoming unsustainable, and it adjusts before the majority understands what is happening. This is not about being early. It is about understanding that once a system begins to crack, the transition from stability to instability happens faster than most expect. And when that transition occurs, decisions are no longer made calmly. They are made under pressure. You need to understand this clearly. The real danger is not the initial decline. The real danger is what follows, because once pressure begins to release, it creates a chain reaction. Participants who are exposed are forced to act. That action creates more pressure. That pressure spreads, and the system begins to move with increasing speed. This is how controlled environments turn into accelerated moves, not because of emotion, but because of structure. And structure does not negotiate. So ask yourself a direct question. Are you positioned based on a narrative, or are you positioned based on structure? Because right now, the structure is beginning to shift, and when structure shifts, outcomes change. This is where awareness becomes critical, not fear, not panic, awareness. Because if you can see what is forming, you can act before the system forces you to act. And in markets, that distinction determines everything. Stop. Now take this one step further, because recognizing that stress exists is only the beginning. What matters is how that stress translates into real consequences and how it affects your position within this system. Markets are not abstract. They are a reflection of behavior. And behavior under pressure follows patterns with remarkable consistency. Most participants believe they are acting independently. They believe they are making rational decisions based on analysis. But in reality, they are responding to the same signals at the same time. Rising prices create confidence. Confidence attracts capital. Capital reinforces the trend. And that reinforcement creates the illusion of stability. But that stability is conditional. It depends on continuation. It depends on liquidity. It depends on the assumption that positions can be maintained without disruption. The moment those conditions begin to shift, everything changes. This is where the transition begins. When price stops moving higher, psychology begins to change. Confidence turns into hesitation. Participants begin to question their positions. At first, the shift is subtle. Some reduce exposure, some take profits. It appears manageable. But beneath the surface, something more important is happening. The system is losing support, and once support weakens in a leveraged environment, the process does not remain controlled for long, because in a leveraged system, support is not just about buyers stepping in. It is about the ability of participants to maintain their positions under changing conditions, and that ability is directly tied to liquidity. The moment liquidity begins to tighten, even slightly, pressure starts to build. Positions that once felt stable become difficult to hold. Margin requirements increase, volatility expands, and participants are no longer making decisions based on strategy. They are making decisions based on necessity. This is where the dynamic shifts completely. This is where forced behavior enters the system, and you need to understand this clearly. Forced behavior is what drives acceleration. It is what turns an orderly market into a disorderly one. Because when participants are forced to act, they do not wait, they do not analyze, they execute. And when enough participants are in that position at the same time, the system begins to move rapidly. This is not emotional selling. This is structural selling. And once it begins, it feeds on itself. Prices decline. That decline increases pressure. Increased pressure forces more selling. And that selling pushes prices even lower. This is the feedback loop. This is how cascades form. And this is the phase where most investors lose control. They assume they will have time to react. They assume they will be able to adjust. But reaction requires stability, and stability is exactly what disappears when the system transitions. This is why liquidity is everything. If you have liquidity, you have optionality. You can step back. You can observe. You can make deliberate decisions. You can protect your capital. But if you do not have liquidity, your choices become limited. Your decisions are dictated by the market. And that is where outcomes diverge. Those with flexibility navigate the environment. Those without it are forced through it. And being forced through a transition is where the majority of damage occurs. Now think about what this means in the current silver environment. If the system is already showing signs of stress, if positioning is crowded, and if liquidity is becoming more selective, then the probability of forced behavior increases. It does not need to happen immediately. It only needs to be possible, because once the conditions exist, the trigger becomes less important. The trigger can be small. It can be a shift in interest rate expectations. It can be movement in the dollar. It can be a change in capital allocation. These are not dramatic events, but in an imbalanced system, they do not need to be, because the outcome is not determined by the size of the trigger. It is determined by the condition of the system itself. If the system is balanced, it absorbs shocks. If the system is fragile, it amplifies them. And right now, the signals are pointing toward fragility. You can see it in the sensitivity of price movements. You can see it in how quickly sentiment shifts. You can see it in how participants react to even minor changes. These are early indicators. They are not random. They are telling you that the system is no longer stable. And this is where most people make a critical mistake. They assume that because the move has not yet accelerated, the risk is not real. They wait. They wait for confirmation. They wait for a clear breakdown. But by the time that breakdown becomes obvious, the environment has already changed. This is why preparation matters more than prediction. You do not need to know the exact timing. You need to understand the direction of risk. You need to recognize when the asymmetry shifts, when the downside begins to outweigh the remaining upside. Because once that shift happens, your objective must change. It is no longer about maximizing returns. It is about preserving capital. And this is where discipline becomes essential. Discipline is not reacting to movement. Discipline is acting before movement forces you to react. It is making decisions while conditions are still manageable, not when they have already become unstable. And I understand this is uncomfortable. It always is. Acting early feels like you might miss further upside. It feels like you are stepping away too soon, but you need to reframe the objective. The goal is not to capture every move. The goal is to avoid the moves that cause irreversible damage. Because once losses compound under pressure, recovery becomes exponentially more difficult. This is the reality most investors ignore. They focus on opportunity. They underestimate risk, and they assume they will be able to adjust when necessary. But markets do not adjust for you. They move according to structure. So ask yourself another direct question. If conditions were to shift rapidly, would you be in control of your decisions, or would the market be making them for you? Because that distinction defines your position within the system. If you are in control, you can navigate. If you are not, you become part of the mechanism. And right now, that mechanism is beginning to activate. You can see it in subtle ways. You can feel it in the change of behavior. The system is no longer as forgiving as it was before. And when that shift begins, it does not reverse easily. It progresses. It builds. It moves forward until the imbalance is corrected. Stop. Now step back and look at the broader picture. Because everything we have discussed is not isolated to silver alone. It is part of a larger cycle that repeats across markets, across time, and across different economic regimes. The asset may change, the narrative may evolve, but the structure remains consistent. Every cycle begins with a valid foundation. There is always a reason for capital to move. There is always a justification that aligns with economic conditions. Then participation increases, confidence builds, leverage expands, and gradually the system shifts from stability to fragility without most participants realizing it. The reason this transition is so difficult to detect is because it does not feel dangerous while it is happening. In fact, it often feels stable. It feels justified. It feels like the system is working, but risk does not appear on the surface. It builds beneath it. And when it reaches a certain threshold, the system no longer needs a major event to change direction. It only needs pressure, and that pressure is already present. You can see it in tightening financial conditions. You can see it in capital rotation. You can see it in the increased sensitivity to smaller signals. These are not coincidences. These are indicators of a system approaching a shift. Most investors are still focused on outcomes. They are asking what will happen next. They are looking for confirmation. But the real focus should be on cause. Because outcomes are always obvious after they occur. Cause is what matters before they occur. And the cause is already visible. Leverage has expanded. Positioning has become crowded. Confidence has increased. These are the exact conditions that precede every major adjustment. Not immediately, but inevitably. And this is why the real question is not if, but when. Now understand what that means. Once the system reaches a certain level of imbalance, it becomes self-correcting. It begins to unwind. And that unwinding does not happen slowly. It happens through acceleration. This never ends quietly. When the system begins to adjust, it reveals everything that was hidden. It exposes weak positioning. It exposes overextended participants. It exposes assumptions that no longer hold. And this is where the difference between preparation and reaction becomes critical. If you are prepared, you have options. You have liquidity. You have flexibility. You can step back and observe. You can act with intention. You can protect your capital. But if you are not prepared, you are forced into the process. You are reacting under pressure. And that is where mistakes compound. This is not about predicting a collapse. It is about recognizing a transition from stability to instability, from controlled movement to accelerated movement, from confidence to constraint. And once that transition begins, it does not pause. It does not wait for consensus. It moves according to structure, and structure is already shifting.